Welcome to the deep dive. Today, our mission really is to simplify a core idea, business valuation.
Mhm.
And we're doing it using, well, a pretty fun source.
Yeah, we're looking at a sixth grader, Jason, and his surprisingly profitable backpack empire, basically selling gum.
Right. It sounds simple, but it's perfect for unpacking this idea of why a dollar tomorrow isn't worth a dollar today.
Exactly.
So let's jump into the numbers, the economics of his operation. It's super straightforward.
It really is. He buys a 5-stick pack of gum for, what, 25 cents?
Just 25 cents, and then he turns around and sells each stick.
Individually for 25 cents each.
So, okay, that's 25 cents cost against, let's see, $1.25 in revenue.
Which means he makes a clear profit of $1 for every single pack he sells.
$1 a pack. And apparently he sells quite a few.
He does. The original story has the narrator and his son, Ben, doing some math. They figured selling maybe 4 or 5 packs a day over the 6 years until he graduates high school. Jason could potentially pull in over $4,000.
Wow. Okay, so that future stream of profits, it's like a real asset.
It absolutely is. And this leads to the core challenge the father gives Ben.
Right, the valuation exercise.
Yeah.
He asks him, okay, if Jason offered to sell you half of all those future gum profits,
All the profits for the next 6 years.
what would you pay him for that today? In cash, right now.
And Ben, he doesn't just guess. He starts thinking it through, gets analytical.
Yeah, he immediately kind of recalculates,
Yeah.
maybe a bit more conservatively.
Right. He estimates maybe a safer total profit figure, say $3,000 over the 6 years, just to be cautious.
Okay, so $3,000 total. His half share would then be $1,500.
$1,500. And this is crucial, he instantly says.
No way am I paying $1,500 today.
Exactly. He gets it instinctively. Why would he hand over $1,500 now just to maybe get that same $1,500 back?
Slowly, drip by drip over 6 years. It doesn't make sense.
He's basically applying, finance 101 concepts, time value of money, and risk.
The risk factor, that's huge here.
It is, because what if the school cracks down and bans selling gum?
Or what if another kid sees Jason's success and starts competing? Undercuts his prices.
Right. Competition could just crush his margins. So even though Ben thinks Jason is like a superhero salesman.
He knows there are real risks that could wipe out those profits.
Definitely. So after some back and forth, some negotiation.
Ben lands on a number he decides he'd pay. $450.
$450 today for the chance to get $1,500 back over 6 years.
Okay, wait, let's unpack that. $450 for a potential $1,500. That's like a 70% discount he's demanding.
It's a massive discount, yeah.
Is that really realistic? I mean, it's just gum. Are the risks that high?
Well, think about it. That 70% discount reflects 2 big things. First, the sheer time involved. 6 years is a long wait. Money now is always better.
Okay, the time value. Got it.
And second, the risk. The possibility of what we call catastrophic risk. One single event, a new principal, a determined competitor could just zero out the whole business overnight.
So the $450 isn't just about waiting, it's the price he's paying for all that uncertainty.
Precisely. It's the price of uncertainty.
And that $450 number, that's really the pivot point here. The father tells Ben, you just figured out what I do for a living.
Right. Finding out what a business is really worth, its fundamental value, and then, buying it for a lot less.
But Ben asks the perfect question next, the one everyone listening probably has.
The $1 million question, or maybe the $1,000 question in this case.
Yeah. He asks, okay, Dad, if a business is truly worth $1,000, why on earth would anyone sell it to you for just $500?
It seems like a paradox, doesn't it? But the source material confirms, this happens. It happens all the time.
Really? There's actually a place where businesses sell for half price.
There is. It's called the stock market, often. Fear, panic, maybe just short-term thinking, bad news cycles.
So people misprice perfectly good businesses because of emotion or short-term noise.
Exactly. They lose sight of the long-term intrinsic value, that $1,500 gum potential, and they sell based on today's anxieties for, say, $450. Identifying that value and buying way below it, that's the game.
Okay, if the concept is that simple, find the $1,500 gum empire, buy it for $450. Why isn't everyone doing this successfully? Why aren't we all rich?
And that brings us neatly to the big catch. The real difficulty isn't necessarily the math. Ben, a 6th grader, figured out the math.
Right. Finding the bargain isn't the hardest part.
No. The truly hard part is twofold. First, you actually have to put in the time to deeply understand the business, the story.
Understand Jason's hustle, his competitive edge, why he succeeds day after day, his resilience.
Yes, understand the why behind the numbers. And the second part, this is maybe even tougher.
This sounds like the psychological part.
It is. You absolutely have to believe in that story. Believe in the investment thesis. Deep down.
Leave it even when things get rough.
Especially then. Because problems will come up. Maybe there's a rumor the school's banning sales. Suddenly fear is everywhere. The market price might drop even lower.
So your math still says $450 was a great deal for the $1,500 potential, but your gut is screaming, get out.
Exactly. Your gut, fueled by all that noise and fear, tells you to sell to cut your losses. If you don't have that core conviction, that belief in Jason's long-term gum profits.
You panic. You sell at the worst possible time, probably locking in a loss.
That's it. That's the difference between just analyzing an investment on paper and actually holding it through thick and thin. The math gets you in, but belief keeps you there.
So the final thought from our sources today, the really provocative idea, is this.
Yeah, it's that even though this concept, Jason's gum business model, is quite simple,
The very few people, maybe even professionals, managing huge sums of money.
truly internalize it. Truly believe the underlying business story enough to stick with it long term when things get scary.
And that lack of deep-seated conviction. That's why finding truly successful, patient, long-term investors is still surprisingly rare.
Even when the bargains, the $450 gum empires, are actually out there.
That's our deep dive for today. Something to think about. Go find your own gum empire and ask yourself if you truly believe in it. Welcome to the deep dive. Today we're getting into something really fundamental. That first big hurdle in personal finance. Actually saving some money.
Right. And then, crucially, what do you do with it? How do you make that dollar you saved actually start working for you?
Exactly. We're digging into the sources today, looking at 3 sort of basic plans for taking, say, $1,000 and hopefully turning it into more. But before we jump into, interest rates and guarantees, there's this great story in the source material about how hard saving can even be.
Oh, yeah.
Yeah, when the author was young, instead of saving up, he spent his cash on stuff in the Johnson Smith Company catalog.
Mm-hmm.
Whoopee cushions, itching powder.
Gag gifts.
Totally. And the big one was this giant weather balloon, like 10 feet by 30 feet. Huge.
A weather balloon. What did he do with it?
Well, they blew it up inside the house with warm air, somehow squeezed this purple thing out the door,
Oh, boy.
and poof, it just floated away. They ended up chasing their entire investment down the street till it popped.
That's almost too perfect, isn't it? An investment literally filled with hot air, zero return.
Exactly. So, okay, let's assume you, listening, have shown more discipline. You resisted the giant balloon temptation.
You've got your starting capital. Let's stick with that $1,000 figure. Now what?
What are the options to make it grow?
Well, this choice is key. You either start earning a reward or, frankly, you pay a penalty.
Okay, let's start with Plan A, which the source calls the mattress plan. Basically, hiding that $1,000 away. Under the mattress, in a safe, whatever.
Yeah, this one kind of stinks, metaphorically speaking. It's not just zero growth. You have to understand this is actually a guaranteed loss.
Oh, loss? How? It's still $1,000, right?
The number is the same, but what it can buy shrinks. That's inflation. If prices go up, let's say just 3% a year, well, after 5 years, your $1,000 buys way less stuff.
Ah, right. You've lost purchasing power. Plus, you missed out on what it could have been earning.
Precisely.
Right.
Which leads us neatly into Plan B, the bank plan, the conventional wisdom approach.
You take the $1,000 to a bank. They pay you interest. The source uses 5% per year as an example.
And that's where compounding starts to work its magic.
Right, because you earn interest not just on the original 1,000, but on the interest it's already made.
Yeah. So that $1,000 after 5 years at 5% grows to $1,276. A definite measurable gain.
That's clearly better than the mattress.
Absolutely. And the big draw here isn't just the return, it's the safety, the certainty. That money is typically insured, FDIC in the U.S. Your principal is guaranteed.
So you're trading potentially higher growth for that peace of mind and knowing the money's there.
Exactly. 5% might not feel like a home run, but it's safe, and it beats inflation, hopefully.
Okay, but what if you are looking for a bit more growth? That brings us to Plan C. Who needs the bank?
This is where you bypass the bank and lend your money directly.
Not to just anyone, though. We're talking about lending to big, established companies. Think like McDonald's, not Bob's Corner Bakery.
Corporate bonds, essentially. And this is where the risk-reward idea really clicks in.
How so?
Well, a big company might offer you, say, 8% interest. That's clearly better than the bank's 5%.
Okay, why would they pay more?
Because you are taking on risk. If that company, let's use the source, a silly example, Bob's House of Flapjacks and Pickles.
Right.
If Bob's goes bust, declares bankruptcy, you could lose everything, not just the interest, your whole $1,000.
Ouch. Okay.
So that higher interest rate, that 8%, that's your compensation for accepting the possibility that Bob's Flapjacks fails. More risk should mean more potential reward.
That makes sense. Risk needs reward.
And this leads us straight to the idea of a benchmark. How do you know if the reward is enough for the risk?
Good question.
You compare it to the safest investment out there, lending money to the U.S. government, U.S. government bonds.
Because the government is, well, pretty unlikely to go bust.
Extremely unlikely. It's considered the foundation. Now, nothing is totally risk-free, but this is the closest we get. The source uses the 10-year government bond rate as the example. Let's say it's paying 6%.
Okay, 6% basically risk-free, though you mentioned inflation is still a risk even there, right?
Absolutely. It's default risk-free, not inflation risk-free. But that 6% becomes your baseline.
So the key takeaway here for you, the listener, is this. If you're looking at any other long-term investment, say, your friend Jason wants money for his new gum business.
Right.
If Jason's gum business isn't projected to return more than that 6% you can get from the government,
then why take the extra risk? You shouldn't do it. You'd be better off just buying the government bond. That 6% is the minimum hurdle for taking on any additional risk.
got it. So wrapping this up then, we've looked at 3 core ways to handle that initial $1,000.
Yep. Plan A, the mattress plan, where your money slowly loses value to inflation.
Yeah.
A guaranteed loser.
Plan B, the bank plan. Safer, FDIC insured usually, with guaranteed interest and the power of compounding. Modest but secure growth.
And Plan C, lending directly via things like corporate bonds, higher potential returns, say 8%, but you take on the real risk of losing your principal if the company fails.
And all of this gets measured against that government bond rate, that 6% risk-free benchmark.
Those are really the fundamental building blocks: zero growth, guaranteed growth, or risk-compensated growth. Understanding these helps you evaluate pretty much any investment.
And it all comes back to that weather balloon story, doesn't it? The final, maybe surprising lesson wasn't just about saving.
Yeah.
It was simply hot air rises. Sometimes the simplest lessons about, physics or finance, they come from those unexpected places. Avoid the hot air investments.
Sound advice. Fundamentals matter.
Welcome to the deep dive. We're digging into some sources today aimed at really demystifying business valuation. But let's start with something a bit different. The appeal of, quick money, high risk.
Ah, the fun money, like betting on the ponies or maybe a greyhound race, that kind of thing.
Exactly. Reminds me of that story, maybe you heard it, about the greyhound that actually caught the mechanical rabbit. The thing was doing like 60 miles an hour.
Oh, I think I have heard that. Chaos, right.
Total chaos. Race disqualified, everyone loses their bets. But apparently the dog itself was totally fine.
Which kind of highlights the difference, doesn't it? That's just, well, unpredictable. Proper investing needs more groundwork. Based on data, not just hope or a fast dog.
Okay, so let's build that groundwork. Our mission for this deep dive. Really understand what owning stock means and how you'd first value a business. We're using a great hypothetical example, Jason's gum shops.
Right. So Jason, he's got the successful gum chain. He wants to sell half of it, and he's looking for $6 million for that half.
But $6 million is a lot for one person. So how does he make it accessible?
Well, he divides the entire company's ownership into 1 million equal pieces. Shares, basically. He keeps half, so 500,000 shares, and sells the other 500,000.
He prices them at $12 each.
Exactly. So 500,000 shares times $12 gets him his $6 million.
So if, say, you decide to buy 10,000 of those shares, that costs you $120,000. And that means you own, what, 1%?
1%. Yep. And this is really key. You own 1% of the company's future earnings, not 1% of the gum display in one store.
Right. It's about the profits it generates down the line.
Precisely. Now, Jason says, okay, 1 million shares total, $12 a share. My business is worth $12 million.
But that's his valuation. The real question for an investor is, what do we think it's worth? Where do we even start?
You start with what you know or what you can know, which is usually last year's performance. We need to look at the income statement.
Okay, let's simplify it. What did Jason's gum shops actually earn last year, the net income figure?
All right, so looking at the number, they had $10 million in total sales. Pretty good.
Okay.
Then you subtract the cost of goods sold, that's the actual gum, packaging, etc. Let's say $6 million.
Leaves $4 million.
Right. Then subtract selling, general, and admin, costs, rent, salaries, marketing, all that. Another $2 million.
So now we're down to $2 million in operating profit.
Yep. And then, gotta pay taxes. Let's assume a 40% tax rate on that $2 million profit, which is $800,000.
Okay.
So $2 million minus $800,000 leaves a final net income of $1.2 million for the year.
$1.2 million. Okay, that's the number. Now, how does that relate back to the shares?
Simple division. You take that $1.2 million in net income and divide it by the total number of shares outstanding, which was 1 million.
For $1.20 per share, that's the earnings per share, or EPS.
Exactly. $1.20 in earnings for each share last year.
And we paid $12 for that share. So we can look at the return just based on that first year. What $1.20 earned on a $12 price?
Yeah.
It's a 10% return.
10%. $1.20 divided by $12. That's your initial return on investment calculation.
10%? I mean, that sounds pretty great, especially when you compare it to, like, super safe options. So why isn't everyone just piling into Jason's stock?
Well, because there's a benchmark, a hurdle. That 10% return needs to be significantly better than what you could get with almost zero risk.
The risk-free rate.
Exactly. We often use the 10-year U.S. government bond yield for that. Let's say it's offering a 6% annual return.
So our 10% does clear that 6% hurdle, at least initially.
Initially, yes. But this is where it gets complicated, because that 10% is based on last year. Investing is all about the future.
Right. The $12 price today isn't for the $1.20 already earned. It's a bet on what it will earn next year and the year after.
Yeah.
And that's guesswork, isn't it?
It's estimation, critical estimation. And it brings up huge questions. Like, first, consistency. Can Jason even keep earning a $1.20 per share? What if a new competitor opens up across the street from every store?
Or what if bubblegum is just a fad? Profits could drop.
Exactly. Or, second, growth. Maybe Jason's planning to expand, go from 10 stores to 20. He does it successfully, maybe earnings double to $2.40 per share.
Or maybe the expansion flops, costs run high, and earnings actually fall. It could go sour, as they say.
Precisely. So your confidence in predicting those future earnings, whether they'll grow, shrink, or stay flat, that's everything when deciding if $12 is a fair price.
Okay, so let's boil this down. Key takeaways seem to be: 1, when you buy a share, you're buying a piece of the future profits.
Correct. Future earnings.
2, valuing that share means you have to estimate what those future earnings will actually be.
That's the core evaluation, yes. Estimation.
And 3, whatever you estimate those earnings to be, the return you expect has to be comfortably higher than that safe, risk-free rate, like the 6% bond yield.
It has to compensate you for the risk that your estimates might be wrong.
Which, I have to say, can feel a bit daunting. You realize you're out there making these predictions.
Yeah.
Guesses, while competing against, pros, analysts with MBAs, PhDs, people who do this all day.
And that really sets up the final thought we want to leave you with. Given how uncertain those future earnings really are, I mean, will they be 20 cents next year, $2? Who really knows? How can an ordinary person, a non-expert, possibly hope to make better guesses about a company's future than these professionals?
That's the fundamental challenge, isn't it?
Right.
How do you even start?
It's the puzzle of investing,
Yeah.
Something to definitely think about. Okay, let's try and unpack this. The mission for this deep dive really is getting our heads around a fundamental, kind of weird thing in the stock market.
Right. How can a company's price just bounce around like crazy
Yeah, doubling or even halving.
when the actual, the business itself seems pretty stable? It's a paradox.
Exactly. So we're digging into some sources that really push back on that academic idea that, price always reflects true value.
Mm-hmm. And instead, we're looking at how this volatility, these wild mood swings you see, how that actually creates huge opportunities.
Opportunities for you, the listener, if you're prepared.
Precisely.
So let's make this concrete. We saw some data, right? On the annual price ranges for massive, well-known companies.
Yeah, blue chip firms, companies that definitely aren't, doubling their factory output or customer base in just a few months.
Take General Motors, huge car manufacturer. Everyone knows them.
In one single year, GM shares were trading as low as $30 and as high as $68.
Wow. So that's basically the market saying the whole company is worth, what, $30 billion 1 month and maybe $60 or $70 billion just a bit later?
It implies that, yeah. A swing of over 100% in perceived value.
And it wasn't just GM. IBM had a similar story, right?
Yep. Shares went from around $55 up to $93 in that same time frame.
Again, suggesting the market's collective opinion on its value just jumped massively. Billions of dollars difference.
Which brings us to the key question, doesn't it? Can the actual value, the real substance of the business,
You mean the factories, the patents, the brand, all that stuff?
exactly, can that genuinely double or get cut in half in just, 12 months?
And the sources we looked at basically scream no.
Pretty much.
Yeah.
They argue really strongly that the fundamental business reality just doesn't fluctuate like that. The price does, wildly,
Yeah.
but not the underlying value.
Okay, so if the fancy theory is trying to explain why prices move like this don't really satisfy, if it's more about, well, emotions and psychology,
Crowd behavior.
then how do we, as investors trying to be rational, deal with that chaos? How do we not just get swept up in it?
Well, that's where we bring in a much simpler, more
Yeah.
behavioral viewpoint,
Yeah.
and it's absolutely key.
The Benjamin Graham idea.
That's the one, the legendary investor. He gave us this brilliant analogy. He said, think of the stock market as this kind of manic depressive guy
Okay.
called Mr. Market. And he's prone to these completely wild, unpredictable mood swings.
So how does this Mr. Market operate? What's the analogy?
Well, imagine he's your business partner.
Yeah.
Every single day he shows up.
At your door.
Metaphorically, yeah. And he says, look, I'll either buy your share of our business from you or I'll sell you my share.
And he names a price each day.
He names a price. And crucially, that price reflects his mood that day.
Mm-hmm.
Could be euphoric, could be utterly depressed.
Okay, so he makes an offer. What are my options then?
This is the beautiful part. You have three choices. You can decide to buy his share at his offered price.
If it seems cheap.
Right. Or you can sell your share to him at his price.
If it seems really high.
Exactly. Or, and this is often the most important choice, you can just do nothing.
Ignore him completely.
Just ignore him. You are never, ever forced to trade with Mr. Market just because he showed up feeling a certain way.
Ah, I see. So you only engage when his mood swings create an obvious opportunity.
Precisely. When he's irrationally pessimistic and offering you a price way, way below what you think the business is worth, that's when you consider buying.
And if he's irrationally exuberant, offering a crazy high price.
Maybe you consider selling. But most days, you just let him rave.
Okay, so that's how you use the volatility. You wait for the extremes. The goal then ultimately is buying a business for much less than it's really worth.
That's the core principle. You want to buy, say, $1,000 worth of real underlying business value.
For maybe $500.
Exactly. But doing that, it requires confidence in your own valuation, and it requires a safety net, protection against Mr. Market staying crazy or you being slightly wrong.
And that safety net has a name, doesn't it?
It does. It's probably the single most critical concept in this whole approach. The margin of safety.
Margin of safety. Okay, what is that exactly?
It's simply the difference, the buffer between your own careful estimate of the business's intrinsic value.
What you think it's really worth per share.
Right. And the price you actually pay for it in the market.
Let's go back to GM. If you did your homework and figured, okay, I think GM is realistically worth about $70 a share.
Mm-hmm. Based on its assets, earnings power, etc.
But Mr. Market is having a terrible day. Maybe there's bad news. And he's offering to sell shares at just $37.
Then buying at $37 when you think it's worth $70 gives you a massive margin of safety. What's that, like $33 per share?
Yeah, a huge cushion. And that cushion protects you how?
Well, think about it. Even if your $70 estimate was a bit optimistic, maybe you made a mistake or things don't pan out quite as well. Maybe the true value was only, say, $60 or even $50 a share.
Right. You were wrong.
You were wrong, but you still bought it at $37.
So even being wrong, you're protected from loss, and you likely still make a decent profit eventually.
That's the power of the margin of safety. It makes investing much safer and allows for reliable, if not always spectacular, profits over time. It accounts for errors and the unpredictable future.
Okay, so if we zoom out, understanding Mr. Market lets you see volatility as an opportunity, not just a risk.
Yeah, and it flips the script.
And then using the margin of safety is how you actually exploit that opportunity without taking huge gambles.
Absolutely. These two concepts used together, they're really the bedrock secrets behind the success of many of the world's greatest long-term investors.
And this seems like the elephant in the room. It all hinges on that first step, doesn't it?
Which is?
Actually figuring out that intrinsic value in the first place. How do you reliably estimate what a complex business like GM is truly worth?
Well, that's the multi-billion-dollar question, isn't it? As the sources point out, that process involves looking years into the future, forecasting earnings, assessing management, competition.
It sounds like a lot of guesswork, frankly. Highly educated guesswork, maybe, but still.
It requires judgment, absolutely, and skill and temperament.
So without getting good at that part, the valuation, well, like the source material says,
Yeah.
you wouldn't know a bargain if Mr. Market slapped you in the face with it.
Pretty much.
Yeah.
Knowing a great price is useless if you don't know the great value you're comparing it against.
Right. That definitely feels like the next big challenge for you to tackle, how to value a business.
Indeed. Something to really mull over.
Yeah.
Keep digging.
Welcome back to the deep dive. We're here to give you that shortcut, to really getting informed.
That's right.
And today, we're looking at finance, but trying to cut through all the complexity. We're aiming for that Karate Kid moment.
Ah, the wax on, wax off. I like it.
Exactly. Those really boring tasks Daniel had to do, they turned out to be the key moves. It's about believing simple stuff can actually work wonders.
It really is. And that's our mission today, isn't it?
Yeah.
We want to unpack just two very basic investment ideas.
Okay.
Concepts that, honestly, if you combine them, could really make you, well, maybe not a karate master, but pretty sharp in the stock market.
Right.
And we're sticking to what we know, past results. No crystal balls, no trying to predict the future, just looking at the facts.
Okay, let's dive in. First secret, finding a bargain price. Our source calls this the earnings yield, or EY.
Yep, earnings yield.
So how do you figure that out? You just take the annual earnings per share, divide that by the current share price, EY, earnings price. Pretty straightforward.
It is. Let's use an example, maybe Jason's Gum Shops from our source material.
Good idea. So Jason's Gum Shops, if a share costs, say, $12, and the business made $1.20 per share last year,
Okay.
you do the math. $1.20 divided by $12, that's 10%. So a 10% earnings yield.
Right, 10%. Now, why does that number matter? It's the return the business is generating for you based on the price you paid. And you need a comparison point. We always look at the risk-free rate. Think of a 10-year U.S. government bond. Right now, maybe it gives you around 6% guaranteed.
Okay, 6% risk-free.
That 6% becomes your sort of minimum hurdle, right?
Yeah.
Your stock purchase needs to offer potentially more than that to be worth the extra risk.
Wait a second. If it's that simple, 10% versus 6%, why isn't everyone just snapping up Jason's Gum Shops? What's the catch? What risk is there?
Well, there's always business risk, of course. Jason's isn't the government. Earnings could go down. That's the risk.
All right.
But the basic rule holds. A higher earnings yield is better. It suggests a better bargain at that moment. Imagine if Jason's earned, say, $3.60 per share instead of $1.20.
On the same $12 price?
Yeah, same $12 price. Now your yield is 30%.
Wow. Okay. That's much better.
Exactly. You obviously prefer 30% to 10%, and both are better than the 6% risk-free rate. You want the business earning way more relative to your purchase price.
So finding a bargain price, a high earnings yield, that's step one. But like you said, there's risk. A cheap stock isn't always a good investment if the company itself is, well, junk.
Precisely. You could get a high yield just because the price has crashed and the company's circling the drain.
Right. So we need the second secret, spotting a good business. And for that, the key metric is return on capital, ROC.
ROC. This one's crucial, maybe the most important factor for quality. It tells you how good the management is at making money from the actual physical stuff they built.
How's it calculated?
You take the yearly earnings and you divide that by the initial cost of building the thing, the store, the factory, the capital invested. ROC, earnings cost.
So it measures how efficiently they turn that initial investment into ongoing profit year after year.
That's it, exactly. Let's compare. Jason's Gum Shops again. Our source says each store earns $200,000 a year,
Okay.
but the store only costs $400,000 to build. So $200,000 earnings divided by $400,000 cost.
That's 50%, a 50% return on capital.
A whopping 50%. That
Yeah.
tells you it's an incredibly efficient business model. They make back half the building cost in profit every year.
That's amazing. Now let's bring in the other example, Jimbo's Just Broccoli.
Oh, poor Jimbo. I love that the source gave us Jimbo. So Jimbo's store also cost $400,000 to build. Same initial investment.
Okay, same cost, but the earnings.
Only $10,000 last year.
Ouch. So $10,000 divided by $400,000, that's 2.5%.
A tiny 2.5% return on capital. So you see the difference immediately. A 50% ROC business is just fundamentally way, way better than a 2.5% ROC business.
Right, it's not even close. And this is where it all comes together, isn't it? The big secret isn't really one secret, but combining the two.
Exactly.
You look for great businesses, the ones with high return on capital, those 50% types like Jason's.
The compounding machines.
Yeah.
Yeah.
And then you wait patiently until, for whatever reason, the market offers them up at a bargain price, meaning a high earnings yield.
High ROC plus high EY. That's the systematic approach. No predictions needed, just observation of performance and price.
It sounds so simple when you put it like that.
It is simple in concept, harder in practice, finding those opportunities. But let's think about Jimbo again for a second. Just broccoli.
Okay.
His business has a 2.5% return on capital. Remember, that's the return on the money he actually spent building the store.
Right, 2.5%. And we just said the risk-free government bond pays, what was it, 6%?
That's 10%, yeah.
So Jimbo went to all the trouble of building a broccoli store, taking on all that business risk, only to earn a return less than half of what he could have gotten just buying a safe government bond.
Makes you wonder, doesn't it? Unless he's absolutely certain broccoli is about to explode globally.
Which seems unlikely for just broccoli.
Then building that store is actually losing him money compared to the safest alternative.
Right.
He's generating less profit than he could risk-free.
So that really frames the final thought for you, the listener. Understanding that simple risk-free rate isn't just academic. It tells you when a business isn't just, mediocre, but potentially actively destructive from a financial standpoint. Earning less than risk-free, that's the real definition of throwing money away. Something to chew on as you look for your own wax-on, wax-off investment gems. Welcome to the Deep Dive. Today, we're exploring these simple, almost systematic ways to invest. The idea of a magic formula. Can you really skip all that super deep analysis and still find, bargains? Real outperformers. Okay, let's get into it. Where did this whole concept of, formula investing even begin?
It's interesting, right? Because this isn't some new gimmick. The groundwork was really laid by Benjamin Graham, investment legend. Graham, the guy behind Mr. Market, Margin of Safety. He saw that most people, frankly, they struggle with valuing businesses properly. He really believed they needed a simple, almost mechanical formula to get good results without taking huge risks.
Right. And his original formula, it was definitely simple, maybe too simple, or at least very strict. He talked about buying net current asset stocks, bargain issues, he called them, meant to be super safe bets.
Precisely. And the rule was tough. The stock price had to be so low, lower than what you'd get if you just, shut the company down.
Yeah.
Liquidated everything, sold off the assets in a, fire sale.
Yeah. And Graham, he actually used this for, over 30 years? Said if you bought a bunch, maybe 20 or 30 of them, the results would be quite satisfactory. That's his phrase. But there's a big catch, isn't there? That original formula, it's kind of useless today, mostly.
That's generally true, yeah. You just don't find many stocks fitting that super strict criteria in modern markets. Not like in the post-crash era he operated in.
Okay, so that original approach is out. What's the alternative then?
Well, the challenge becomes finding a new formula, something more flexible but still systematic, one that finds good businesses but also at bargain prices, something that actually works now. That's the whole point of this modern approach.
Got it. And this newer system, it boils down to two main things.
That's right. Two core ideas combined. First, you want that bargain price, so you look for a high earnings yield.
Okay, high earnings relative to price, cheap.
Exactly. And second, you need a good business that's measured by high return on capital, how much profit it makes relative to, the cost of its assets, factories, stores, that sort of thing.
Okay, wait. High earnings yield tells me it's cheap. Why layer on the good business part? If it's dirt cheap, isn't that the bargain we're looking for?
That's the key insight, really. See, earnings yield is just the flip side of the PE ratio, right? We use yields because it's easier to compare. But if you only look for high yield, super cheap stocks, you'd often just buy junk. Companies that are cheap for a very good reason, maybe they're failing.
Okay, I see. The cheap traps.
Exactly. But flip side, if you only looked for a high return on capital, the best quality companies, you'd probably end up paying way too much. Those stocks are often expensive.
So the formula forces a compromise. You can't have the absolute best quality and the absolute cheapest price usually.
Precisely. It makes you find companies that are pretty good on both fronts. The best overall combination of value and quality.
All right, so we have these two factors. How does the system actually pick the stocks? It ranks them, you said.
Yeah, it's all about the combined rank. So imagine you've got this big list, maybe the top 3,500 U.S. stocks. The system ranks every single one from 1 down to 3,500 based on return on capital. Then it does the whole ranking again, 1 to 3,500, based on earnings yield.
Two separate rankings for every stock.
Right. And the stocks it actually selects are the ones with the best total score when you add those two ranks together.
Right.
So maybe a stock is ranked, say, 232nd on capital and 153rd on earnings yield. That's a combined score of 385. That stock would likely be preferred over one that's maybe ranked first, number 1 on return on capital, but way down at 1150th on earnings yield. The combined score matters most.
Okay, that makes sense. It balances the two factors. But the big question, the really important one, does this simple system actually work? Did it beat the market? Let's look at the numbers. The source material mentioned a 17-year study.
Yes, and the results were,
Yeah.
well, they were pretty staggering. Over that 17-year period, this formula, investing in about 30 stocks at a time, it returned 30.8% per year.
30.8% annually for 17 years.
Yeah.
Wow. Okay, compare that to the market.
Well, the overall market average during that same time was about 12.3% per year.
So more than double the market return.
Way more than double when you compound it.
Yeah.
Let's put it in perspective for you, the listener. If you started with, say, $11,000, at that 30.8% rate for 17 years, you'd end up with over $1 million.
$1 million from 11,000.
Over $1 million. Whereas that same $11,000 invested in the market average at 12.3%, that would have grown to only about $79,000.
Okay. That is a huge difference. The source actually said the results worked too well, didn't it?
It did seem almost unbelievable, yeah.
So the bottom line here seems to be that this kind of disciplined, systematic approach, identifying good businesses that are also priced cheaply, it can work. And work really well, significantly better than just buying the index based on this study. No complex forecasts needed, just sticking to the system.
Exactly. Which brings up maybe the most interesting point.
Yeah.
The source suggests that, understanding the mechanics, the ranking, that's not the hard part. The real challenge, it's the investor's own belief. Having the conviction in the logic to actually stick with it, especially when the market gets rocky or the formula has a bad year or two. So if the logic seems simple and the historical results are that strong, what's stopping people? Why is it so hard to just follow through? That's maybe something for you to think about. What's the real obstacle to implementing something like this?
Welcome back to the deep dive. You know that great old quote, "It's the things we know that ain't so."
Right. Artemis Ward.
Exactly. And it really fits what we're tackling today. We've got this theoretical magic formula for picking stocks. On paper, spectacular results.
Almost too good to be true, really.
That's the mission for this deep dive. Do these amazing returns hold up in the real world, or was it, just a lucky streak on paper?
Yeah, we need to figure out if it's actually practical. Because a formula that, say, doubles the market is, well, it's useless if you can't actually use it.
Right.
So there are three big hurdles we need to check. First, are the companies involved just too small? Like, can you actually buy them in decent amounts?
Okay.
Second, was it just luck? Did they happen to test it during a weird 17-year period?
Uh-huh.
And third, the big one maybe, can the opportunity just disappear? If everyone knows about it, does it stop working?
Okay, those make sense. But maybe before we hit those, just a quick refresh. What exactly is this formula looking for? Broad strokes.
Good point. Yeah, we don't need the full math, but the core idea is pretty neat. It filters stocks based on two main things.
Okay.
Value and quality. So it wants companies that are cheap compared to their earnings. That's the value part.
Makes sense.
And at the same time, companies that generate high returns on the capital they use, that's the quality piece. Sort of the best of both worlds.
Got it. Cheap and good. Okay, let's tackle hurdle one then. Size. The thing we know that ain't so might be that you need tiny, obscure stocks for huge returns.
Exactly. The worry is, if the formula picks microcaps, the minute anyone tries to buy, the price shoots up and poof, the edge is gone.
So did the research look at bigger companies, ones you could actually invest in?
Oh, absolutely.
Yeah.
They specifically tested this. They filtered out the really small stuff first. When they applied the formula just to the largest 2,500 companies, we're talking a minimum market value of $200 million here.
Okay, so not tiny.
Not tiny at all. The formula still returned 23.7% per year, compounded, over the whole 17-year study.
Wait, 23.7%? What did the market do for that same group?
The average for those 2,500 stocks was 12.4%.
Wow. Okay, so it pretty much doubled the market, even avoiding the really small companies.
And they pushed it even further. They did an ultimate test, focusing only on the largest 1,000 stocks. Think over $1 billion in market value, the big leagues.
Where you'd expect efficiency to kill any edge?
You'd think so. But even there, the formula pulled in 22.9% compounded annually.
Seriously?
Yep, against an 11.7% market average for that specific group of large stocks.
Okay, so the idea that it only works on tiny stocks, that seems pretty thoroughly debunked.
It really does. That thing we knew just wasn't so.
All right, but hurdle number 2, luck. Maybe those 17 years were just special, or they got lucky with a few superstar stocks in the portfolio.
That's a fair question, but the scale of the study helps here. Remember, they rebalanced the portfolio about 30 stocks every single year. Across all those tests, the 3,500, the 2,500, the 1,000 stock groups over 17 years, that adds up to over 4,500 separate stock selections being made based on the formula.
4,500 picks.
Yeah, to get that kind of consistent outperformance across that many individual selections over nearly 2 decades, calling it just luck gets, well, pretty hard to justify.
Okay, point taken. The volume makes pure luck seem unlikely. So that brings us to the third fear, scarcity. If this thing works, won't everyone jump in and bid up the best 30 stocks until the advantage is gone?
And this is where I think the most convincing piece of evidence comes in. They did a ranking test.
How did that work?
They took those 2,500 larger companies and ranked them from 1 all the way down to 2,500 based on how well they scored on the formula, that combo of value and quality.
So rank 1 is the absolute best, according to the formula.
Exactly. Rank 2,500 is the absolute worst. Then they divided the whole list into 10 equal groups, or deciles, 250 stocks in each group.
Okay, got the setup. What did the results show?
This is the really cool part. The formula worked in order. Group 1, the top ranked 250 stocks. They returned 17.9% per year.
That's strong.
Very. But then Group 2, the next 250, did better than Group 3. Group 3 beat Group 4, all the way down the line.
You're kidding. So the ranking actually predicted performance.
Highly predictive. Group 10, the absolute bottom-ranked stocks according to the formula, they only returned 2.5% annually. Barely above inflation, really.
Wow. So it's not just finding some good stocks, it's actually sorting the whole universe pretty accurately.
Precisely. That gradient, where each group performs roughly in line with its rank, that tells you something powerful.
Yeah, it suggests the formula isn't just finding a few needles in a haystack.
Exactly. It seems to be an incredibly accurate indicator of how a group of stocks is likely to perform.
Yeah.
And because whole groups perform well, not just the top 30.
You're not fighting over just a tiny handful of stocks. There should always be plenty of highly ranked companies to choose from. It solves that scarcity problem.
That's the conclusion, yeah. There should always be opportunities available if the ranking holds.
Okay, let's recap them. We started worrying if this magic formula was just theory. But the tests show, 1, it seems to work for large companies, not just tiny ones.
Right. Liquidity isn't the barrier we thought.
2, with thousands of stock picks over 17 years, it's really hard to chalk it up to just luck.
The sheer volume argues against that.
And 3, this ranging test suggests the formula is genuinely predictive, meaning there should be a continuous stream of opportunities, not just a few scarce bargains.
It paints a pretty compelling picture of practical applicability.
It really does. So let me pose that final big question to you, the listener, building on what the source material asks. If this evidence is so strong and the method is basically public knowledge now, won't everybody start doing it? And if they do, won't that collective action eventually, ruin everything and make the formula stop working in the future?
That's the million-dollar question, isn't it? The paradox of publishing a successful strategy. Something to definitely chew on.
Welcome to the deep dive. Today, we're tackling a really interesting strategic puzzle. Why does a method that ultimately wins big often demand, years of really painful failure along the way? Maybe we can start with that historical parallel. The American Revolution, right? You had the British Army, hugely successful for ages, with their bright red coats marching in formation. Super predictable, but it worked. Until, the context shifted. Suddenly, they were easy targets against colonists using guerrilla tactics.
That's a perfect way to frame it. Because a winning strategy, especially in investing, it often stops winning if everyone can easily copy it. We're looking today at this quantitative value approach, sometimes called the magic formula, or MF.
Right, the disciplined stock-picking system.
Exactly. And our mission really is to understand why its periods of, frankly, terrible performance aren't a bug. They're actually a necessary feature for its long-term success, for the few who can stick it out. Think about the core logic. What if this MF worked perfectly every single month, every year?
Well, everyone would jump on it, wouldn't they?
Immediately. They'd buy up all the bargain stocks the formula identified, prices shoot up.
Poof, the bargains are gone. The formula eats itself.
Precisely. So it needs these rough patches to function.
Okay, but you look at the data from that successful 17-year test, it did worse than the market in 5 out of every 12 months. That sounds pretty bad on the surface. Why even call it magic?
because over that entire 17-year period, the total returns are often double, sometimes almost triple the market average. The payoff is huge. But yeah, the cost is that lumpiness. The path there is rough.
And that lumpiness is where the human element comes in, isn't it?
Absolutely. It's the real barrier to entry.
Yeah.
Can you stomach watching your portfolio lag, maybe even shrink while others are booming?
And those losing streaks, the numbers are pretty stark. The formula sometimes trailed the market for over 2 years straight. And get this, for about 1 out of every 6 multi-year periods tested, it underperformed for 3 consecutive years.
3 years.
Imagine that. 3 years of feeling like you're wrong.
That's the whole psychological game right there. Sticking with a plan, showing 0 or negative relative returns for 36 months. Especially when your friends or competitors are, killing it. It's incredibly difficult.
Almost impossible for most.
And that lack of sticking power is what actually preserves the opportunity for the disciplined few who do stay the course.
Yeah, and we even see supposed experts bail out. There's that famous story of the best-selling investment author launched a fund using his own winning formula.
Right, I know the why.
And then the fund just tanks, relatively speaking. Yeah. Underperforms the market 2 out of its first 3 years. 1 year it was down like 25% versus the market.
Yeah.
So what happens? The author himself sells his management company. He gets out.
And misses the rebound.
Totally misses it. The next 3 years, the fund, following the exact same rules, snaps back and becomes a top performer since its inception. He just couldn't stomach his own medicine during the downturn.
It's incredible. And there's the other case. The manager, often called the smartest guy in the room, starts his own firm, great long-term strategy.
But the first few years?
Disaster, relatively. Underperformed the major indexes for, I think, 3 or 4 years running.
The clients?
Ran for the exits. The vast majority pulled their money out, panic. But he stuck to his guns, kept executing the strategy.
And eventually,
the returns just crushed the market. Firm grows to manage, $10 billion? But guess how many of the original clients were still there to benefit?
Oh no, how many?
4. Just 4 original clients remained.
Wow. So, okay, the takeaway here seems pretty clear. The formula, this kind of strategy, it works. The long-term numbers can be amazing.
Potentially double or triple the market.
But those returns are just incredibly lumpy, as you said. Success isn't really about the math, is it? It's about having this deep down conviction, enough belief to stick with something that looks like it's failing for years.
Exactly right. It's about psychology and time horizon, not just calculation. The hardest part isn't finding or understanding the strategy.
It's living with it.
It's having the sheer faith, the intestinal fortitude to keep going when every market signal, every news headline, maybe even your own gut, is screaming that you're wrong.
So the final question for you listening is maybe this.
Yeah, knowing these statistics, knowing a winning strategy must have these painful losing streaks. How long could you realistically stick with it? Could you endure, say, 3 years of underperformance, even if you intellectually knew it was statistically likely to win big eventually? It's a tough question. Welcome to the Deep Dive. Today, we're trying to get to the core logic, the really timeless stuff, behind a specific investment strategy.
Yeah, getting past all the market noise.
Exactly. Finding principles that are so, solid that you can stick with them. And we're kicking off with maybe the strangest phrase you'll hear in finance. So it sounds like a weird dare, actually.
It really does. The phrase is vomit under the 3M spaces and run.
See?
Told you.
It sounds absolutely nuts, right? But it was, believe it or not, an old mnemonic from print shops for setting the bottom row of a type case, VUT, then the 3M space, then AR.
Okay, so super specific knowledge. And completely useless now with digital printing.
Totally transient. And that's the whole point. Really,
Yeah.
We want the opposite, right?
Yeah.
Principles that last like 2 + 2 = 4, not tips that expire.
Right. So if this classic formula we're looking at is so logical and, the long-term results seem to back it up, why isn't everyone using it and getting rich? There must be a reason people jump ship. Well, that's the crux, isn't it? Knowing the logic is one thing, sticking with it is another. The strategy itself is designed to systematically find basically above average companies that you can then buy at below average prices. It does this by ranking companies based on 2 key things: high return on capital, or ROC, and then also a high earnings yield.
All right, let's unpack that first one. Return on capital, ROC. The sources you send over use this Jason's Gum Shops example. Maybe walk us through that. What makes a high ROC company special?
Yeah, Jason's Gum Shops is a great way to picture an above-average business. So imagine Jason invests, say, $400,000 to build a new gum shop.
Okay.
And in the first year, that shop brings in $200,000 in profit. That's a 50% annual return on his capital. Just phenomenal.
50%. You don't see that every day.
Exactly. Finding investments that genuinely yield 50% year after year is incredibly rare. That's what makes the business above average.
And here's where, for me, the conviction part starts clicking.
Yeah.
Because that 50% isn't just a number. It's like it fuels itself, right? Jason takes his $200,000 profit.
Yeah. He could put in a safe bond, make maybe 6%. So what's that? $12,000, maybe $7,200 after tax. Slow. Predictable. Fine.
Right, the safe route.
But what if Jason can reinvest that whole $200,000 back into his own business? Maybe build half a new store that also makes 50%.
Now you're talking. If he does that, he suddenly earns an extra $100,000 from that reinvestment. His total earnings jump from $200,000 a year to $300,000.
A 50% growth in earnings in just 1 year.
Precisely. That opportunity, the ability to reinvest profits back into the business at those super high rates, that's the engine driving really strong earnings growth over time.
Okay, so that's the goal. Find these high ROC engines. But, Capitalism 101 says if something's that profitable, everyone piles in.
Yeah.
Competition should flood the market, drive down prices, and push that amazing 50% ROC down towards, well, something average, 40%, 30, maybe less.
That's absolutely right. Capitalism is designed to compete away excess profits. It's relentless. Which brings up a really key question.
How does the formula find companies that keep that high ROC? Exactly. If high returns naturally get competed away, the formula flags must have some kind of, let's call it a special advantage, a moat, something that protects those profits from competitors.
Right, a competitive advantage. And the sources mention different types, like maybe a totally new product category, like the iPod was for a while.
Yeah, or just a much better product.
Or a super strong brand name like Coke that lets them charge a bit more. Or like eBay, where just having the most buyers and sellers makes it the best place to be. A network effect.
All great examples. So that first filter, the ROC screen, it essentially does the first big cut. It helps us skip analyzing hundreds of, frankly, mediocre or poor businesses.
Like the Just Broccoli Company example they used. Not much of a moat there?
Probably not. So it filters out the ordinary and points us towards these potentially good companies that likely have some kind of durable, protected earning power.
Okay, makes sense. Find a great business with high ROC, protected by a moat. But that's only step one, right? Just finding a Ferrari doesn't mean you should pay $1 billion for it.
Precisely. That's where the second filter is crucial, the high earnings yield.
Earnings yield, so earnings divided by price, EP.
Right. It's basically asking, how much is this company earning right now relative to the price we're paying for its stock? We want a high number here, too. It ensures we're buying these great companies, but at a bargain price. We're not overpaying.
So the whole strategy boils down to find above-average companies.
And buy them at below-average prices. It's elegantly simple, really.
The logic feels sound. You can explain it. But sticking with it when the market tanks and your portfolio's down.
Yeah.
That's different. It seems like the real challenge isn't the what, it's the why. Finding that personal conviction to not bail.
And maybe that brings us back to where we started, in a way. That leads to a final thought for you to ponder. If real knowledge needs conviction behind it, what seemingly useless, maybe even ridiculous piece of information?
Like a print shot mnemonic.
Yeah. What silly anchor will be the thing you hold on to, the thing that helps you stick to a logical strategy when the headlines are screaming sell and everyone thinks you're crazy?
Something to think about. Just remember, folks, if you absolutely must vomit under the 3MS spaces, don't forget to run. We'll catch you next time for another deep dive. Okay, so you know how sometimes the fun of doing something, doesn't really match up with how good you are at it?
Oh, yeah. I know that feeling. Definitely.
Right. Like, I read this story about a sailor, loved being out on the water, but apparently was, well, kind of terrible. Almost got totally crushed by a massive barge.
Wow.
Seriously.
Yeah. Fun for him, maybe, but not exactly successful sailing. And investing can feel a bit like that sometimes, can't it? We get caught up in the emotion, the story, instead of what actually works systematically.
That's a great analogy, actually.
So today, we're going to dive into the long-term track record of this thing called the magic formula. Our mission is really to look past the gut feelings and understand the mechanics and the pretty amazing long-term odds it seems to offer.
And it's important to say right up front, it's not really magic. It's disciplined value investing. Simple, really.
Simple how?
It's systematic. It just looks for companies based on two things: a high return on capital, which signals a good business, and a high earnings yield, which signals it's cheap. Good and cheap. Okay, good and cheap. Sounds sensible.
Exactly. So let's talk results. There was the 17-year test period, right? From 1988 through 2004.
Okay.
Now, if you only try this for, say, a year, you gotta know, the data shows you'll likely underperform the market average, maybe 1 out of every 4 years.
1 in 4. So short term, it can be frustrating.
Definitely. It's sort of the price you pay, the entry fee for the long-term results.
Okay, so sticking with it is key. What's the payoff then, if you do stick with it, like longer term?
Now that's where it gets interesting. If you look at 3-year periods, just focusing on the biggest 1,000 stocks, the formula beat the market averages 95% of the time.
95% out of how many periods?
That was 160 times out of 169 3-year windows they tested. Pretty good odds.
Yeah, that's really good.
But wait, it gets even better, especially for, individual investors like many of us.
How so?
If you expand the list of stocks you choose from, maybe to the top 3,500 companies, anything over about $50 million market value, then the formula beat the market averages 100% of the time.
100%. Over all 169 periods.
Yep, every single one. 0 failures in beating the market over 3 years in that group.
Wow. Okay, that's compelling.
It really is. But to fully appreciate that, we kind of need to redefine risk. What does risk really mean if you're investing for the long haul?
Good question. It's not just the daily swings, is it?
Exactly. For long-term folks, it's mainly 2 things, right? One, what's the actual risk of, losing your money permanently over that long term?
Right.
And 2, what's the risk that you'll just do worse than other reasonable options, like just buying an index fund over that same long period?
Right. Losing money or just underperforming?
Precisely. And the data on the magic formula for that 17-year test, it's pretty clear-cut.
How so?
During that whole period, the strategy never lost money in any single 3-year time frame.
Never. 0 losing periods over 3 years.
0. 100% profitable. Even when it didn't beat the market, which was rare, it still made money. The worst 3-year return for the big stocks was still a gain of 11%.
11% gain was the worst.
For the large caps, yeah. And for that bigger group, the 3,500 stocks, the worst was a 35% gain over 3 years.
35% gain as the low point. Okay, now compare that to just owning the market average.
Big difference. The overall market averages actually lost money in about 12% of those same 3-year periods.
12% of the time the market lost money.
Yeah, and the worst drop for the market was pretty steep, like down 45 or 46% in its worst 3-year stretch.
Ouch. Okay, so the takeaway is better results and less risk of actually losing money.
That's exactly it. Better returns, much lower downside risk.
Okay, but this brings up that classic investing question, maybe framed around Mr. Market. The idea that the market is kind of moody short term.
Right, Benjamin Graham's idea, your emotional business partner.
Yeah. So if Mr. Market is so irrational sometimes, how do we know that a stock we buy cheap won't just stay cheap forever? What makes the price eventually go up to fair value?
That's a crucial point. Mr. Market might be emotional day to day, but long-term reality tends to bite. There are forces that push prices toward value.
Like what?
Well, 3 main things, really. First, other smart investors. Eventually, enough people notice a great company selling way too cheap, and they start buying. Demand pushes the price up.
Okay, so other buyers recognize the bargain. Makes sense.
Second, the company itself can act. If its stock is undervalued, the company might buy back its own shares. Fewer shares out there usually means the price per share drifts upwards.
Share buybacks, right.
And third, if a company stays a bargain for too long, another company or maybe a private equity firm might just say, hey, this whole business is on sale, and make an offer to buy the entire thing.
A takeover.
Exactly. And that forces the price up towards fair value for everyone holding the shares.
So these mechanisms kind of guarantee that value eventually gets recognized. How long does that usually take?
Well, it can take longer, no guarantees on timing, but the author, Greenblatt, tells his MBA students that usually 2 to 3 years is enough time.
2 to 3 years. Which lines up perfectly with why the formula's 3-year success rate was so incredibly high.
It's not a coincidence, no. The market eventually catches on, usually within that kind of time frame.
Okay, so let's wrap this deep dive up. Key takeaways seem to be: 1, the formula. Works really well, maybe even better than advertised if you look longer term.
Mm-hmm.
2, it seems to deliver those better results with actually less risk than just tracking the market averages, especially over 3 years or more.
Definitely less downside risk, yeah.
And 3, this idea that, company value, the actual economics, eventually wins out over Mr. Market's short-term mood swings because of things like buybacks and takeovers.
That's the core logic. Reality asserts itself.
It provides a certain confidence, doesn't it?
It should. And maybe here's a final thought for you to chew on. If just having a 3 to 5 year view gives you such a massive edge over most other investors, what kind of advantage do you think you get if you can genuinely, truly extend your time horizon out to 10 or maybe even 20 years? Think about that competitive edge.
Welcome to the deep dive. We know exactly where you might be right now. Maybe you're thinking about rejecting investment formulas altogether. You want to pick your own stocks, right? But listen to this warning from our sources. Choosing stocks without really knowing what you're after. It's like running through a dynamite factory holding a lit match.
Wow. Yeah, it's a pretty terrifying picture, but it definitely sets the stage.
It does.
So our mission today isn't really to tell you not to pick stocks. It's more about how we can use the ideas behind something like the magic formula so you can do it smartly and hopefully avoid that, explosion.
Right. So maybe quickly remind us, what are those core magic formula ideas again?
Sure. It really boils down to 2 main things. First, high earnings yield. That's basically how much a company earns compared to its price. Think of it like the flip side of the PE ratio.
Got it. Cheapness relative to earnings.
Exactly. And second, high return on capital. This just shows how efficiently the company makes money from the stuff it needs to own to operate, its assets.
Okay, simple enough. But here's the bit that seems weird. The value of a stock, that depends on future earnings, doesn't it?
Absolutely. Future cash flows are everything.
So why on earth does the magic formula use last year's earnings for those calculations? That feels completely backward, like driving while looking only in the rearview mirror.
Yeah, it does seem counterintuitive, but here's the kind of clever part about why it works for the formula. Often, the companies it picks look pretty ugly in the short term.
Ugly how?
Maybe bad press, a temporary setback, something that scares off other investors. And that's why the price is low, why it's a potential bargain.
Oh.
So by using last year's earnings, which might have been, more normal or even unusually good before the recent trouble, the formula spots these temporary situations. It finds deals that humans, reacting emotionally to the bad news, might just run away from.
So the formula is finding these temporarily beaten down companies where the past numbers suggest it might bounce back.
In a nutshell, yes. It's exploiting a sort of short-term market overreaction, statistically speaking.
But that's the formula. What about us? If we want to ditch the formula, pick stocks ourselves, we probably shouldn't be using last year's numbers.
No, exactly right. That's the critical difference. The ideal way for an individual investor, the gold standard, is to actually estimate earnings for a normal year.
A normal year, like looking ahead.
Yeah, maybe looking out 3-4 years, trying to figure out what the business can earn without, the distortions of a boom or a bust. And it means you also have to think about future growth, management quality, honesty. It's a much deeper dive.
Okay, that sounds hard, like really hard. That's not something you just do casually on a Saturday afternoon.
It is hard. And that leads directly to the core warning here. If you can't do that kind of analysis, if you can't realistically estimate those normal earnings and figure out what a business is truly worth, then the sources are really blunt. You probably have no business investing in individual stocks on your own. Full stop.
Wow. Okay, that's a tough message. But hang on, if we can't use old data, why does the formula get a pass?
Good question. It gets back to the difference between picking one stock versus building a portfolio.
Oh, so?
The magic formula isn't trying to find the one winner. It picks a whole basket, maybe 20 or 30 stocks. For any single company, last year's earnings might be a terrible predictor. Could be totally wrong.
Okay.
But on average, across that whole group of 20 or 30 statistically cheap, high-return companies, last year's numbers turn out to be a surprisingly decent proxy for future potential. It's pure statistics. Law of averages.
Got it. So it's about diversification within the formula's picks, which means for us as individuals, the path we take really depends on being honest about our own abilities.
Precisely.
Yeah.
So path number 1 is for the few, the really dedicated investors who can do that hard work of estimating normal earnings.
The experts, basically.
You could say that.
Yeah.
For them, the advice is interesting. Own less, not more.
Less. That sounds risky.
Think of a successful local business person, right? If they have $1 million to invest, do they sprinkle it across 30 random companies they barely know?
Probably not. They'd pick a few they really understand.
Exactly. They might buy big stakes in, say, 5 to 8 businesses they've researched deeply, understand inside out, and know are selling cheap. For investors with that skill, owning just 5 to 8 great companies in different industries, well, that can mean more profit and more safety, and frankly, probably more fun too.
Okay, that makes sense for the pros. But what about the rest of us? People who are curious, want to be involved, but admit they aren't, valuation gurus.
That's path number 2, the compromise path, let's call it.
All right, what's a compromise?
You still use the magic formulas rankings, you let it do the initial heavy lifting, but you only look at maybe the top 50 or top 100 companies it spits out.
So you're starting with a pre-screened list of potentially good candidates.
Right. They've already passed the high yield and high return tests, statistically speaking. Then, from that list, you pick your favorites. Maybe 10, maybe up to 30 stocks in total.
And how do you pick favorites from that list?
Well, ideally, you do a little extra research. But the source even jokes if your final criteria are kind of arbitrary, like based on their birth signs or something, well, then you should probably stick closer to owning 30 stocks for more diversification.
Huh. Okay, so lean towards more stocks if your selection method is less rigorous.
Basically, yes. Spread the risk more if your conviction isn't based on deep analysis.
It's interesting what you said earlier about owning less being potentially safer for experts.
It really highlights a psychological trap, doesn't it? Mr. Market, the mood swings of the stock market often makes people feel like owning just 5 or 8 companies you've intensely researched is way riskier
Yeah.
than owning, say, 50 companies you know almost nothing about. But for someone who's actually done the work, that concentration based on real knowledge is where the real safety and potential lies.
So pulling this all together, the biggest takeaway isn't necessarily don't pick stocks. It's more about know thyself, isn't it?
I think that's exactly it. You really have to assess your own skill level, honestly.
Are you capable of that deep, expert-level analysis needed for a concentrated portfolio? Or does the compromise path using the formulas list as a starting point make more sense?
Or perhaps recognizing that for many people, maybe even most people, sticking purely to the formula or just a broad index fund is the most sensible route.
It forces you to ask, which category do you fall into right now? Something to really think about next time you're tempted by that flashing ticker symbol.
Okay, let's unpack this. We're doing a deep dive into investment advice, specifically, where you should put money you won't need for, say, 3 to 5 years, maybe much longer.
Right. And you're looking for high returns, but without unreasonable risk.
Exactly. It's a huge topic for anyone serious about building wealth long term.
It really is. And the mission here, I think, is crucial because our sources basically deliver this really harsh assessment of the people supposedly helping you out.
Yeah, people assume there's a system working for them, but
But you have to look at the incentives, right? How these people get paid.
I was really struck by that core metaphor used. On Wall Street, there ain't no tooth fairy.
Yeah, it's blunt.
It is. But it hits home. Money won't just, magically appear. You're kind of on your own.
And understanding why you're on your own means looking at how the quote-unquote experts are compensated.
Okay, so let's take the usual suspects. The friendly neighborhood stockbroker first.
Ah, the broker. Well, the main issue there is their incentive. They get paid a fee, a commission, to sell you something, a stock, a bond, some product.
So their job isn't necessarily to make you money, it's to make a transaction happen.
Precisely. Their training often focuses more on sales and compliance roles than, deep market analysis aimed at beating the averages.
Okay, so brokers are maybe not the best bet. What about mutual funds? That's where most smaller investors end up, right?
Yeah, that's the common choice. And they do offer diversification, which is good. You get exposure to maybe 30, maybe up to 200 different securities.
Sounds efficient, spreads the risk.
It is efficient for a small investor starting out, but it leads to twin problems for beating the market. First, over-diversification.
Meaning it's hard to have any special insight when you own hundreds of stocks.
Exactly. You end up looking a lot like the overall market. Many managers actually do what's called closet indexing.
So they mimic the market to avoid underperforming badly.
Right. But they still charge you those high fees, as if they were actively making brilliant picks.
And that's the second problem. The fees. Basic math, really. Average market returns minus fees equals.
Below average returns. It's almost guaranteed over the long run.
Plus that whole idea that a fund with a great track record will keep winning.
Yeah, the data shows there's pretty much no reliable link between good past performance and good future performance for the average fund.
So relying on past winners is a bit of a trap.
It often is. Sometimes the fund just got too big, or the manager left, or their style went out of favor.
Okay, what about the other end? Hedge funds. For the really wealthy investors.
Right. Typically needs like $500,000 or more just to get in.
And the fees there are legendary, aren't they?
Oh, yeah. Usually something like 1% of your total assets every year, plus maybe 20% of any profits they make for you. It's often called 1 in 20 or 2 in 20.
Wow. So do they justify those massive fees?
Well, the conclusion from the source material is mostly no. There just aren't that many truly brilliant managers who can consistently beat the market after accounting for those huge costs.
So basically putting your money under a professional's pillow, whether it's a broker, a mutual fund, or even a hedge fund, often leads to kind of lousy performance compared to the market itself.
That's the sobering takeaway, yes.
So if you want to avoid that, what's the baseline? You mentioned just settling for average.
Yeah, and here's the surprising thing. Average is actually pretty good.
How so?
Well, for investors who want to do, the least amount of work possible, an index fund is a perfectly fine choice, something tracking the S&P 500 or the Russell 2000.
It just tries to match the market return.
Exactly. It aims to equal the overall market's performance, minus a very, very small fee.
And you mentioned a stat over the last 80 years or so.
Yeah, the average stock market return has been over 10% per year. So settling for that average is actually, historically, a pretty solid win. It sets a high bar for anyone trying to beat it.
Okay, but what if you do want to try and beat the market? If the funds aren't the answer, what's left?
You're left with basically two paths, according to the sources. One is the really hard way, analyzing individual stocks yourself. That takes time, skill, the ability to really evaluate a business.
Not for everyone, then. What's the other path?
The other path is using a specific quantitative step-by-step approach. The source material calls it the magic formula.
The magic formula. Okay, let's clarify that for the listener. What is it, essentially?
Sure. It's a system designed to find good companies at bargain prices, based purely on numbers. It ranks stocks using two main factors.
Which are?
First, a high earnings yield, basically, getting a lot of profit relative to the price you pay. That finds cheap businesses.
Okay, cheapness. And second?
Second is a high return on capital. That finds good, high-quality businesses that are efficient at generating profits from their assets.
So cheap and good. Sounds simple enough. Rank stocks, buy the top ones, repeat.
The mechanics are simple. It only takes maybe a few minutes every few months.
But there's always a but, isn't there? You said the hard part isn't the work.
Exactly. The hard part isn't the math or the time involved. It's sticking with it.
Sticking with it when?
When things get tough. When the market goes down, or when this specific strategy is temporarily underperforming, which will happen sometimes.
So it's about conviction, believing in the system, even when the news, the so-called experts, or just market sentiment, Mr. Market, is telling you you're wrong.
That's the real challenge. Maintaining faith in a logical, quantitative process through thick and thin. It requires discipline.
So wrapping this up, the core lesson seems to be nobody on Wall Street has your back by default. There's no tooth fairy.
That's it. You have to accept that reality.
And then choose your path deliberately. Either accept the average with indexing, or if you want to beat the market, use a disciplined approach like individual analysis or a quantitative system like this magic formula.
A systematic path is key if you're not indexing.
Right. And the source material leaves us with one final kind of provocative thought. If you actually follow a successful strategy like this, what are you going to do with all that money?
That's a good problem to have, isn't it? Something to definitely think about.
Welcome to the deep dive. Today, we're looking at something pretty interesting, how the basic rules of investing, time and discipline, how they connect, maybe surprisingly, to tackling big societal problems. We're diving into source material that links compound growth to fixing public education.
Yeah, it's about taking those financial principles, the sort of raw math of how money grows, and asking a much bigger question. The materials actually kick off by asking you, the listener, something provocative. What would you do with a lot of money? After the essentials are covered, families taken care of. That journey, they argue, starts with being radically efficient with your finances.
Okay, let's unpack this. The source material is a bit cagey, right? They say they won't really teach compounding formally, but then, bam, they hit you with some frankly, shocking numbers. We're talking about using a simple IRA, just a standard retirement account, and contributing, get this, only $28,000 total over just 6 years. And then you stop completely.
Right. And what's fascinating, or maybe eye-opening, is the potential they illustrate. If that initial 28 grand managed a 25% annual return.
Whoa, hang on. 25% a year? That sounds, well, extremely optimistic, doesn't it? Are they just trying to make a point with a huge number?
They definitely are using it to hammer home the power of time. They do note it's aggressive, though achievable historically with certain focused strategies. But the point is, even if you add nothing more after those first 6 years, that money could, theoretically, balloon to over $1.6 million after 20 years.
Okay, 1.6 million, that's already pretty wild from just 28K.
But wait, it gets better, or more illustrative, I guess. After 30 years, it's over $13.4 million.
$13.4 million from the initial $28,000.
Wow, exactly. And here's the real kicker, the part that really shows the value of starting early. If you had actually kept contributing every single year for all 30 years, you'd end up with around $16.5 million.
So wait, let me get this straight. Stopping after 6 years gets you $13.4 million. Contributing for 30 years gets you $16.5 million. That means those first 6 years did almost all the heavy lifting. Like what, 80% of the final result?
Precisely. It's the time the money is invested that's the real magic multiplier, much more than the total amount you shovel in later.
Right. It reminds me of that example they share telling high school kids about a 25-cent piece of gum.
Yeah, that little analogy. That 25 cents, if you somehow invested it at that same 25% rate for 30 years, it could be worth over $200 by the time you're middle-aged. It just drives home the scale.
Okay, so step 1. Achieve financial efficiency, harness that compounding power early, but then the materials seem to shift gears a bit.
And they do. They acknowledge their principles work, but they also add a dose of realism. Future market returns might be lower. Maybe, 6 to 10% average, not the historical 12% or their aggressive 25% example.
Which brings up a bigger question about,
Hardest.
well, purpose, right?
Exactly. If you do reach financial independence, is spending all your time glued to stock tickers the best use of your intellect and energy? The author argues pretty strongly that maybe 95% of daily stock trading is just noise. It's like a spectator sport. The company itself gets nothing when shares just trade hands between investors.
It's just shuffling ownership, not building the actual business.
Right. So the ultimate point they're making is use that financial success, leverage it, make a difference, give back. There are probably higher, better uses for your time and brain power than just optimizing portfolio gains indefinitely.
Okay, so if that's the standard for our personal capital, find the best use, the highest return on effort. Shouldn't we apply that same thinking to public money, to institutions?
That's the pivot. And that's where they bring in the concept of return on capital, or ROC, applied to public education.
They focus on education, saying it's critical, it fuels the workforce, grows the economy. Makes sense. But then they hit us with another stark statistic. In most big U.S. cities, barely half of the kids who start 9th grade actually graduate high school.
Barely half. Think about that from an investment perspective. That's a huge amount of, wasted potential.
Yeah.
Wasted capital.
Yeah, a devastating waste.
And they use this really clear business analogy.
Yeah.
Imagine a company, call it Just Broccoli Inc.
Okay, just broccoli.
If Just Broccoli consistently fails, if it provides a terrible return on the capital invested in it, what happens in a capitalist system?
Well, eventually investors pull out, right? It goes bust. The money moves somewhere else, somewhere more productive.
Exactly. Capital gets redirected. But now apply that ROC idea to public schools. The system, as it often works now, lacks that feedback loop. It's incredibly difficult, sometimes nearly impossible, to fire ineffective teachers or pay great teachers more or even close failing schools.
So the money keeps flowing into efforts with very low returns, and it's almost never redirected systematically to, better approaches.
Right. The core problem identified is that lack of, consequences, lack of incentives tied to actual performance, lack of penalties for failure. So any real solution, whether it's reform within the public system or charter schools or voucher programs, has to tackle that fundamental issue. It needs that financial logic, that focus on results.
Wow. So we went from a single quarter turning into hundreds of dollars, all the way to the massive societal cost. When capital isn't used efficiently in something as vital as education, the underlying principle is the same though, isn't it?
Yeah.
Efficiency matters. High returns matter.
It really does tie together. The source wraps up by framing education itself, teaching kids the skills they need to be productive citizens, as potentially the highest ROC investment we could make. A great investment, as they put it.
So for you, the listener, maybe the final thought is this. You've likely spent time thinking about how to invest your money for the best financial return. Now consider this. What societal challenge out there offers the highest return on capital for your time, your effort, your focus? Where can you make the biggest difference?